Long-term movements in the currency market generally correlate with economic cycles. These economic cycles tend to repeat themselves, and so they can be predicted with a reasonable degree of accuracy. Repetition is the key, since the entire premise of technical analysis lies in using historical price movements to predict future price movement. In the stock market, the fundamentals of a particular company can change radically in a short period of time. This makes past stock prices irrelevant in the prediction of future movement. There is no predictable economic cycle in the life of a company or in the life of an individual stock. As a result, technical analysis becomes a hit or miss proposition in the stock market. In the Forex market, we are trading the economies of entire countries. The fundamentals of these countries change very slowly, making the boom-bust nature of the economic cycle easier to predict. Which would you consider more accurate? A survey of 5 people or a survey of 5,000 people? If the survey is performed in a fair and even-handed manner, the larger sample of information will generally reveal the more accurate result. The greater size and liquidity of the Forex market gives technical analysts a larger sample of information from which to draw. There are many more trades and much more money changing hands than in any stock market or futures market. The currency market contains more data points, making a statistical sampling like technical analysis more accurate. Also, the vast liquidity found in the currency market makes it much less likely that insignificant players will disrupt the market and temporarily skew technical indicators, which is common in less liquid markets. One stock trader can easily influence the price of an illiquid stock, but it is much more difficult and expensive to exert influence over exchange rates. For example, imagine a stock that trades an average daily volume of just 20,000 shares per day. If a trader places a market order to buy 10,000 shares of the stock, what do you think will happen? Because this order is equal to 50% of the stock's average daily volume, the price rockets higher, as the available offers are all absorbed. In a very real sense, one trader has single-handedly moved the market for that stock. While this scenario is common in the equity markets, it is unheard of in the currency markets. The sheer size of the Forex market makes this type of reaction nearly impossible. In fact, there have been numerous occasions where governments and central banks have tried to exert their influence over currency exchange rates and failed. It's natural to have a fear of the unknown, and this is normal human behavior. I remember when I first decided to get involved with Forex trading, there were many concerns weighing on my mind. What would the charts look like? Would I have to abandon my current trading style and learn some esoteric new method of trading? There are common concerns of traders who want to experience the advantages of Forex but are reluctant to leave their comfort zone. As we take a look at charts of Forex exchange rates, the first thing that will become apparent is that they are not very different from the charts of other trading vehicles such as stocks or commodities. For experienced equities and futures traders, the good news is that nearly everything you already know about technical analysis can be applied to the Forex market. Forex charts contain familiar patterns like the head and shoulders, double tops, double bottoms, and symmetrical and asymmetrical triangles, and so on. Forex traders use moving averages, Bollinger Bands, moving average convergence, divergence, all of the same indicators that equity and futures traders use. There are breakouts, pullbacks, retracements, consolidations, ranges and trends, and so on. For example, the figure in front of you shows a pattern that is familiar to traders who use technical analysis, a double top formation in the Euro-US dollar pair. Experienced traders of stocks and commodities will see many familiar formations and patterns in the charts of currency pairs. For example, have a look at the massive head and shoulders that formed over a 3-year period on the dollar-yen pair. Forex traders use support and resistance levels to determine the best location for entry and stop orders, just like the equity and futures traders. In the figure in front of you, the dollar loonie, US dollar Canadian dollar, currency pair finds support repeatedly at the 1.2 level. Traders who are familiar with candlestick charting patterns will note a series of hammers, dojis, spinning tops, and other reversal candles at the support level. Strategies involving trend lines and channels are also popular in the Forex markets. For example, in the daily charts of the dollar Swissy currency pair, we can see 2 distinct separate channels, one moving higher and one moving lower. Note that when the first channel fails, the uptrend dissolves into a double top, which is then followed by a downtrend.